The RE as a hidden wall LSTRET signal most retail investors mismaster it, and you'll trade well. For the next 12 to 18 months, Tom Li, Fundstrat's chief strategist, has changed his research focus. His team used to publish Fed rate forecasts daily. Reckoned they set short-term policy aside to study long-term industry data. Commercial aerospace supply chains, global computing infrastructure lay out 30 years of U.S. market-style rotation. Lee never chases market hype. He researches contrarian trends when investors hold one-sided views. He spotted every major market turning point months before mainstream consensus formed. By the time retail traders caught up, most rally gains were already priced in. His latest research lines up with conflicting financial headlines today. News seems full of contradictions. Analysts debate 2026 Fed rate cuts. Pundit has warned the AI bubble will burst. SpaceX completed America's largest IPO. Commentators predict trade SURI and dollar collapse. RT headlines each move markets. Combined, they reveal a clear trend. Global capital is undergoing a decade-long shift. SIS is no sudden market crash, nor a fast short-term profit play. Grasp this long-term trend, and you'll avoid reckless buy and sell losses. Miss a shift, and outdated assets will drag down your portfolio returns. Told A, we decode all market signals. 18 months U.S. market core logic. We institutional money flows sim play strategies for regular investors. Comment below risky as or opportunities. I read every viewer comment. Stare at with the Fed era LRES RVE. The biggest market variable lately. Still CK traders all know one rule. Fed statements outweigh corporate earnings. Tech H stocks swing with interest rates. Gold, crypto, and real estate track liquidity. The core logic is simple. Leak UID 80 drove all asset gains for a decade. ESY money lifts every asset class. TIG Ninja triggers broad sell-offs. The old trading playbook was fixed. Buy heavy if the Fed signals cuts. Hold cash if easing gets delayed. But June market data signals a shift. The Fed keeps high benchmark rates. Last year, hawkish news crashed Nasdaq. Now indexes dip then rebound quickly. Instead, UTIs changed their core question. From MVN, will rates get cut? To how much higher can AI run? A critical mindset shift has arrived. Liquidity is no longer the core issue. Asset overvaluation takes center stage. Lee's team studied decades of Fed cycles and summed up a reliable rule. If all traders only bet on Fed moves, liquidity-fueled rallies will soon end. His classic analogy is easy to follow. Liquidity is river water. Stoics are boats floating on top. Racing water lifts all boats. Yes, yet overvalued boats sink easily. Extra easing cannot prop up inflated prices. Next key observation. Fractured markets. Major indexes hit new highs, but internal market structure is broken. While viewers claim AI remains strong, SEV and mega cap tech stocks prop up indices, yet very few stocks beat market benchmarks. Most small and mid caps trade sideways. Traded INL industries keep sliding down. Now let us break down the divisive AI sector. Mass capital floods AI-related stocks. Why compare AI to the 2000 internet revolution? I agree AI is transformative tech that boosts efficiency across all industries. But two questions must stay separated. What real value does this technology hold? Do current stock prices match that value? The internet changed global life forever, yet the dot-com bubble crashed brutally. EVs reshaped auto manufacturing. But EV stocks once lost half their value. Grow aren't NG tech and inflated valuations can coexist without contradiction. Tom Li holds a balanced take on AI bubbles. He rejects both extreme bear and bull views. First, real bubbles form without public doubt. Ongoing debates over AI valuations prove we haven't hit peak speculative mania. Second, modern AI differs from early internet. .com firms had concepts, no steady revenue, told as AI cuts enterprise costs and generates tangible operating cash flow. CIRD severe industry split lies ahead, Survivor's own core computing tech, stable cash flow, and unbreakable business modes. Lee always prioritizes industry fundamentals. Instead of following volatile market sentiment, Institutional owner El Capital is rotating away from pricey AI stocks for new growth tracks. This week's biggest market event, SpaceX IPO, its stock rose 3 sessions straight. Market cap hits $2.66 trillion, passing Amazon. It acquired AI firms to link space and compute. Most investors only see SpaceX as a rocket firm. Few ask why it chose this exact IPO window. AI valuations sit at multi-year peaks. All institutions fixate on Fed rate decisions. Global liquidity pressure hits record highs. Capital markets follow a solid rule. Large firms time IPOs for peak risk appetite to lock in the highest possible valuations. SpaceX listing sends a clear signal. Big funds urgently need new long-term growth stories. The 2-year AI rally has fully priced in most short-term growth catalysts. Markets need larger capacity assets to absorb capital. Exiting overpriced tech giants. Commercial space infrastructure fits perfectly. It covers satellite communication, orbital transport, and foundational AI hardware across long cycles. Lee's late 2025 internal research pointed out next-gen hard infrastructure as the decade's core asset. AI belongs to software innovation. All software relies on physical hardware support, global data centers, cross-border telecom lines, and orbital satellite facilities. Lee favors classic pick and shovel assets during gold rushes. Tool suppliers earn steady gains. Compute E and space infrastructure are the tools of this tech revolution. We can simplify the capital rotation timeline. Past T years, Fed liquidity controlled markets, REC tiers. AI software led all rallies. Next decade, space and computing take over man, while investors fear us debt and dollar collapse. U.S. national debt tops $35 trillion. TSU rise interest expenses keep rising quarterly. On LN doomsday articles spread rapidly, yet a short-term dollar system collapse is extremely unlikely. Dollar dominance relies on a decades-old global financial system. Nearly all trade, reserves, commodities, and cross-border deals are settled in US dollars. SIS system ties every nation's core interests together. RJUST main TS will unfold slowly, never overnight. NK of a huge cargo ship, it turns very gradually. Lee often comments on media as crash hype, shows say value, catastrophic views, attract more clicks. Real financial system shifts evolve incrementally. Slow W gray rhino risks beat obvious black swan events. His long-term macro judgment stays clear. The dollar is a TON is a multi-decade trend. CONTRIs diversify foreign exchange reserves to build a multi-polar global currency system. CI's transition takes 10 to 30 years. Shorter term, the dollar remains the top settlement currency. US TSU rate stays the world as primary safe haven. No need to panic over financial doomsday. Focus on slow structural market changes instead. By the time retail investors notice, the long trend will already be well established. Core E forecast for the next 18 months: no full-scale systemic financial meltdown, no non-stop one-way bull market rally. While LSTR enters a high volatility range era, indices swing back and forth constantly. Sector leadership rotates at fast speeds. Overall, the AI stocks correct after rallies. Space and compute rebound on pullbacks. Short term traders face huge disadvantages. China's G momentum creates instant losses. Selling G early triggers quick market rebounds. Free QANT trades drag down overall returns. Long-term value investors gain from volatility. Leave changing wealth accumulates amid market divergence, not during universal bullish euphoria. Instead, UTONs haven't abandoned us equities. Never put all capital into one single hot sector. Over CONCE on almost always causes deep losses. Sustainable investing requires diversification and patience. RARU E1, how the ample liquid cash reserves. never run a fully invested portfolio. DP market corrections will keep happening. Cash lets you buy quality assets at cheap prices. Lee calls cash a put option for market panic sell-offs. Raru E2, do not chase trending hot sectors. Buy positions on natural price pullbacks. Blind momentum buying causes most retail losses. Lee's classic line, deep sea favor long-term investors on LY hold firms with intact long-term fundamentals. Do not buy assets you cannot fully understand. Raru ECRE divers EFI holdings across core long tracks. OVO IDO RWITG a single stock. Core long plays, computing data hubs, commercial space. No one can perfectly predict the final industry leader mix sector leading stocks and corresponding ETFs capture full trend gains without picking the top stock. Raru E4 RX star and your investment timeline cut down daily stock chart checking frequent intraday price checks distort judgment and trigger impulsive buy high sell low moves long G term. Wealth comes from holding full industrial cycles, not one single perfect short-term trade. Most retail traders chase daily price gains. A small group of long-term funds quietly accumulates new cycle assets and waits for industrial growth catalysts to arrive. 4L Core Recap Chart RTC Financial Headlines Hide one clear truth. A decade-long global capital migration has started. Market driving forces shift permanently from Fed liquidity reliance to hard tech infrastructure. Capital flows from concentrated AI megacaps to new growth sectors. Show RT term volatility rises with new long-term opportunities emerging. Lee's lifelong investing mantra, market as reward patient, rational independent thinkers. GRE and fear are investing's biggest enemies. Long-termism and industry fundamentals survive all market cycles. Comment your favored sector for the next 12 months. AI compute, commercial space, or other verticals. We can exchange opinions together. See you in the next market analysis video.